Good afternoon, everyone, and welcome to our market update. Today, just myself, Mark Allara. I'll be covering off on a topical subject at the moment, which deals with the implications of Labor's proposed franking policy, particularly a focus on self-managed super funds and self-funded retirees. Today, I'm joined by Kenneth Beanland, investment advisor for Mortgages North Key, and he's just going to run through a market update and review of what the landscape looks like at the moment. So kick things off. So I suppose the first part here is just to look at the process we'll go through is just looking at, well, what is a policy? Just at a high level stuff. We don't have a lot of details beyond the intention behind it, and then that's what we're really looking at. And then going through a process of saying, well, what is franking, and how does it come about? What's the intention of the process that's in place at the moment? How does that impact, existing retirees or self-funded, individuals? And then more importantly, how does this policy impact that? And what are the practical implications of that? But the practical implications are from, really from an income perspective, and then what flows from that? What happens to particular markets? What happens to particular investment strategies? And where to from here? And are there things that we should be doing right now in lieu of a potential policy? At this stage, obviously, it's hypothetical because Labor are in opposition at the moment. But I think it's remiss of us not to start taking these things into consideration. So I think the first part is saying, look, what are the implications of this? So at the moment, Labor released their proposed surplus franking credit policy, which is effective 1 July 2019. What it means is that superannuation funds, amongst some other individuals, they're not going to be able to claim surplus franking credits. And those surplus franking credits come about where the surplus credits over and above tax that would be otherwise payable. Not surprising, upon the announcement, there's much backlash from financial advisors, other professionals in market commentators, but clients obviously have a vested stake in this. And given the realisation of the potential political fallout and how wide stretching this was, and it probably wasn't intended to cover that wide or the impact that wide. It actually impacted not just self-funded retirees, but broader individuals that were on Centrelink pensions and so forth. So it took about 2 weeks, and then there was a revised policy which was badged as the pensioner guarantee. And essentially what that is that policy was to exempt full and part-time pensioners, as well as pensioners who were a current recipient of a self-managed super fund, but before the 28th of March 2018. So to set that up, what does the current landscape look like? So firstly, it's important, I believe it's important to understand the fundamentals behind the franking system. At the moment, a company pays tax, in the Australian tax system, a company pays tax at 30 cents on the dollar. The franking system, so when a dollar is earned, the company pays tax at 30 cents, and that goes into a franking account. When a company passes the profits on to the shareholders, who are the ultimate owners of that company, so that they're not double taxed, that tax credit that the company's paid passes on with it. So the important distinction there is that if you earn $1 and the company pays tax at 30 cents, then you're not going to get the dividend down to the individual, and then that individual pays tax at, say, if they had a margin rate around the 30 cents as well, then they wouldn't be paid tax, because then the double taxation of that puts it way above our highest marginal tax rate. So the way to deal with that was actually to pass that tax credit on, and then ultimately, if we look through, regardless of legal structures, under the veil of those legal structures, if you have a company that pays a dividend to a super fund pays pension to the individuals, ultimately, it's always going to come back to an individual and their tax rate. So what it really needs to do is accommodate for those tax credits all the way through, so that that individual is not discriminated against. So I think, in my personal opinion, the important part here is to realise that this is not a windfall. This is basically a tax system in place to make it fair, so that individuals ultimately are treated alike. And the different types of income, whether they're a trust distribution with no franking credits or a company dividend with franking credits or interest from cash account, is treated in the same vein. So I think that's really important, because the message behind that is that it's not a windfall, it's actually an entitlement for a fair system, and particularly in my personal view anyway. So the impact of that is that if you look at a self-managed super fund or any super fund, in pension phase, there's two phases: accumulation phase and a pension phase. Accumulation phase is that the income is taxed at 15 cents in the dollar. In pension phase, so any assets that you use to back a pension, they're exempt from income tax and capital gains tax. So in pension phase, it's an effective zero tax rate. So essentially, what this policy is about is that under the current system, where you earn $1 or you get and the company pays tax at 30 cents in the dollar, when you get that dividend, you're required to gross up that dividend with the tax credit. So to effectively put the full assessable amount back at that dollar. And what this policy is about is that in a zero tax rate environment or a lower tax rate environment, those franking credits or tax credits are actually refunded back to the fund or to the individual. Just like if you overpaid your personal PAYG tax, then you'd get a refund upon assessment, and it's treated in a similar way. So what the policy is about is to not allow those surplus franking credits back. So I think, in my personal opinion, this is not a political view from me. This is actually whether this was issued by the LNP or the Labor. I just think it's a very poor policy and requires some further consideration. So today was all about, what is the impact and real implications of this policy, and really to mums and dads out there, how does it impact them, and what are the things that they should be considering? So the best way, the easiest way to show this was actually just to run through a super fund. Now I've had Kenneth, who's joined here, do up a sample portfolio, but had a particular focus for yield to highlight the issues. It's by no means investment recommendations, it's just an example only. So with that there, we did a self-managed super fund with members' balances of $1 million. We did a risk profile of a balanced investor, quite common, which held, and what that really means is 50% of the assets are held in defensive assets, cash and fixed interest, and 50% of assets are held in growth assets. In this case, which is shares and property, both domestic and international shares. In this case, the focus is particularly on Australian domestic shares, because that's where the franking system impacts. And to be truthful, portfolios that come across our desk, it's not uncommon to see banks are favoured, Woolies and Wesfarmers, BHP and Rio, all those type of investments are very highly held with self-managed super funds, and so we've utilised some of those as an example. So as you can see there, $1 million, 50% in shares and 50% in fixed interest and cash. So that's the example of the portfolio. So if you look at the top line, ANZ Bank, the current price, please disregard the price targets on the right-hand side. It's just for an internal use only. It's absolutely not advice around that target price. This is for illustrative purposes only. So if you follow the front one across, we'll only go through the ANZ. Quantity of their shares there, the current price is 26.82, total market value of 43,000. Percentage of the overall portfolio was 4.4. It goes through the projected income, but the two columns that we need to focus on here is the projected yield. So that's a cash yield, so that's a dividend yield that's paid by ANZ Bank of 5.97%, and this is also based on the market value and the dividends forecast. And the franking credit, you'll notice it's at 100%. As you go down to some of the other assets, if you look at below that core holdings of growth asset, there are investments there like Macquarie Atlas Roads, which have zero franking. And certain trust structures, Spark Infrastructure, Sydney Airports, they're not companies, so they're not paying the tax. Some of them are stapled securities, but in this case, like the Spark Infrastructure, we're just looking at really focusing on the franking. So across the top, The franking represents the tax paid. So what we do is that we gross that yield up to work out what is the actual true yield of that. Because in the true sense, that's the amount that forms assessable. If you have assessable income, is the grossed up version, and that's also the amount that the tax is calculated on. So in this case, we use that because looking at an ANZ bank there at 8.52% yield, that's the true yield, because as it currently stands, that tax credits, whilst there's a timing issue, in pension phase, those tax credits come back to the fund. So the cash comes in two forms, one in the dividend, one in the tax refund. As we flow through the portfolio there, we can look at the fixed interest, and we'll just look at the, I'll look at the Westpac one, which is the bottom one, because I'm going to refer to that later in the presentation. So what that is we're focused here on hybrid securities, some more capital note. They are we use them in fixed interest space. They're a preference share, and they're called hybrid because they have fixed interest characteristics, or, but they are a preference share. So they pay a fixed margin above a floating bank bill rate. In these particular examples, you can have fixed rate ones, but in these examples, that's what we are utilising. So if we look at that bottom one there, Westpac Capital Notes, what we're looking there is they pay the money on a fixed margin on above a 90-day bank bill rate or 180-day bank bill rate on a face value of $100. In this particular case, the market's discounted that, and Kenneth will go through a little bit later about what this policy, what we've seen the impact on that fixed interest market. So the market price is 97.50. So the projected yield, which is the cash yield, so that's what you physically receive, is 3.72%. The franking credit on that will gross the yield up to 5.32%. So if you keep that in mind, 5.32%, because we'll cover this later, is the yield that you get on that note. Overall portfolio, 6.4% on $1 million. It's a little bit higher than probably what's out there. Markets come back a bit, and we've had a particular focus. We don't have international exposure here. We're just focusing on the income. What that means, so this comes out of our system. So I've taken out the current portfolio. You see a red line through there. But if you run through that quickly, cash, that's just interest of $700. The fixed interest, that's the cash yield of $17,909. We have no property exposure in this for this example. Shares, domestic shares, $29,069 gives a total income of $47,679. Now, then the next part is the total franking credits that's attached to those investments, which is $16,315. That gives us a gross yield of approximately $64,000. And that's really, that part there of that $16,315 is really what this policy is about. So with the assumption, what we've done is we've done some modelling just to show, well, what is the true impact on this, from a cash flow perspective, but also there's other things that impact it, longevity calcs, how long does my capital last, what does my asset mix mean now, and so forth. So what we've done on an assumption basis is for this here is look at the compliance cost. Self-managed fund, we've just used a $3,000 annual compliance fee, so plus GST, so $3,300. And we've used a 0.5% advisor fee for investment and strategic advice, which is 0.55% included. So on the initial $1 million, 0.88%. The mum and dad here would like a desired, on this example, it's a desired income of $75,000. So first part is to look at that, what it looks like in its current format, and then what does it look like if this policy was in place. So the gross income, approximately $64,000. We take out the operating expenses of $8,800. Gives a net income of $55,200. So roughly a 5.5% yield on the initial $1 million. If we adjust that for the franking credit removal or proposed policy from Labor, then what it means is that the gross income actually drops back to $48,000. Because if we go back to the slide before, that $16,000 there, $16,315 is removed, and so we go to the line above it. The total income of $47,639 is actually what the net income, because you don't get a refund on that. And remember, we're a pension phase, so there's no other assessable income to offset that. So if we look at that, the 48,000, we still have the same operating expenses, because we've still got the same capital value, we've still got the same fixed legal compliance costs. It gives us a net income of 39,200. So if we look at the gross income levels, the 64 to the 48, that's approximately a 25% drop or reduction in income. Because we have some fixed compliance costs, when we look at it from a net income, that's a reduction in income available to pay pensions of approximately 29%. So the message here is that based on the example that's provided, this policy can have a 1/3 reduction, well, not quite, but close to a 1/3 reduction to the income for a pensioner, which means your pension will either be reduced and you'll have to adjust your cost of living now, or you will have some longevity of capital issues and you'll have to adjust your lifestyle into the future. So the message here is a very real, it impacts lives genuinely. It's a real issue, and it's a very serious concern for self-funded retirees. So to give you an example of that, the impact on longevity of capital and income, I suppose you'd call it a light blue or a mauve colour. It's an example of taking the franking credits out. So if the policy was, if Labor were in power and the policy was in its current format was in place, then you'd remove those franking credits, and you can see that versus the darker purple or maroon colour there, you can see the impact on what it actually does. And what it does is clearly accelerate the reduction of capital, accelerate your capital usage as a result of that. Result of that is that two things. One is, you won't be able to sustain your desired pension level, or two is that you won't be able to sustain it for the same period of time. So there we go. So to give you a bit of an idea, the top one there is just looking at the income makeup, and the top one there is to show if the franking credits were in place. So what it is we use this as a commencing pension at age 60, so a self-funded retiree deploying up stumps at 60. The yellow is the income from the pension. The blue is the income. So sorry, the total bar, the first bar is actually the total pension, but the yellow represents what the funds earned in income, and the light blue there is the capital usage, because the yield on the portfolio does not cover full expenses. As you see, it goes into a green area there. That green represents Centrelink support, and then when you work all the way through, and it kicks in a bit later because of being eligible to qualify for Centrelink, and then as you move through that, you'll see the red part there, and that red part represents a shortfall. So the graph below is if the franking credits policy was abolished and the surplus credits could not be refunded back to the fund. It obviously impacts two levels. One is the lower income, and then therefore we require greater Centrelink support because our capital values is falling down. Second is that we actually, the red part, you'll see that come through forward, which means that we've got a shortfall earlier. So some, what's that, 7 years or so, that it's impacted the lifestyle. So I guess the point of that is really just to show an example that the outcome of this policy is actually genuine, and the outcome of that policy is that it impacts from a longevity of capital usage and income required for retirees. This is really a quick slide. I'm conscious of time, so I'll move through pretty quick. What are the potential impacts on investments and the super fund investment strategies? So the way to go back to that is a simple risk and reward. And so to look at that, I'm just looking at the hybrid fixed interest market at the moment. And so what I really want to send home the message there is that, and these are not uncommon investments within, super funds and personal names and entities alike. If you look at that highlighted Westpac Capital notes there, as we go across, the projected yield there is 3.72%. So that's a cash yield you receive. you get the franking credits at the moment, which means your gross yield is 5.32%. So what that's telling us is for Westpac to raise those monies, the market's saying, yep, an appropriate return on that money for the risk, given the issuer's strength, given the type of security and the functions of those securities, the attributes of those securities, an appropriate risk for that return is 5.32%. So it's even the market's adjusted that price down from $100 face value to $97.50 to take into consideration, other market attributes. So, and that's fine, 5.32% for the level of risk. The problem here is that if those franking credits aren't there and a self-managed super fund or a pension account owns this asset, we're not accessing that franking credit. So effectively, you've received a 30% drop in return, no ability to receive the gross income or offset because we're in a zero tax rate environment, yet our risk is the same. So 3.72% return for that level of risk is not appropriate. And so that's where we need to move forward going, well, if this is in place, what is the impact on the underlying investment, the market itself, and what is the impact on what do the trustees need to consider as part of their investment strategy? And one of those is obviously risk and return. And in this space, the risk and return on that particular example of security actually changes quite significantly, that the trustees need to reconsider their investment strategy. Now, that portfolio is not exactly, we try to manage things across different levels of capital structures. It's just by way of example only. And Kenneth will actually, touch on that briefly about what the impact on the market that's had already. So just quickly summing this up, in the past year we've had the age pension reduced, we've been restricted, the transfer balance cap of 1.6 has been introduced, and now we're realising, potential entitlement of franking credits may be abolished. It really puts pressure on this space and the ability to strategise and the ability to, be self-funded and rely on the systems in place what we work for. There's no doubt that our past strategies and our future retirement strategies, all being equal, rely on these franking credits to generate the income within super funds. Without that, it does aid longevity of capital, it does assist in annual income, and we're in an ultra low cash rate environment, an ageing population. It's a real issue. So regardless of what you're planning, not only does it impact that, but with people, with mums and dads trying to, where possible, try and create longevity in their capital and preserve the capital base, it actually becomes bequeathing issues to the next generation. And the example doesn't take into consideration any other family assets. So sum this up, what do we do now? Well, actually nothing. There's not much we can do because we need to put in perspective at the moment, Labor as sitting in its opposition, so it's hypothetical at this stage. But there is a real risk of changing governments at the next election. So, so we might as well be mindful of this and just keep abreast of this and start thinking about what opportunities and what risks lie within our investment portfolios and the way that we structure our income streams. We will continue to monitor how this unfolds and continue to provide updates to clients as possible. But, like always, if you've got concerns about the policy, you want to discuss that. If you're worried about how this impacts you personally, things that you might want to consider, or just from an investment strategy point of view, please give us a call. So thanks for that. What we'll do now is pass it over to Kenneth, and Kenneth's going to give a market update, investment market update. Kenneth?
Thanks, Mark. So I thought I'd start off by giving a high-level view of the reporting season that we had in February. And the first pleasing thing to note was the fact that large capitalisation businesses, so the quality blue chip end of our market, the top 50, actually had stronger results than anticipated. We had only 2 misses, and if you look down in that bottom right-hand corner, we had 7 above analyst expectations. So that, compared to other past reporting seasons, was quite positive. The main drivers of our index, so you've got your top 50 there, and they really drive how our market performs over the next 6 months. So that was the first pleasing result. The second positive aspect to the February reporting season was the fact that we usually have a deterioration in earnings estimates. So we start the half year off with analysts being very positive over the next 6 months, and then slowly but surely they whittle their earning estimates down to about 3 or 4%. So that's what's previously been happening, but this time we actually saw that didn't happen. So the results coming in were actually as anticipated 6 months ago. So overall, that led to about a 7% profit growth, which was pretty pleasing. The main sectors that we saw really give positive earnings updates was in the commodity and energy space, and I'll touch a little bit more on stock specifics, but one that I think does deserve a mention in that top 50 was CSL. It was one of the best reports out of the top 200. So overall, it was a pretty solid reporting season. So what happens after companies report? We find that there is a more of a trend happening now where if a company either beats or misses, that after the result, they will continue to perform that way. And we think that's because that once we'll just take an example, so a company that beats, and that they beat market expectations, analysts then read through their numbers, that everyone jumps on the first day, the analysts then redo their models, they get upgraded price targets, upgraded earnings, and then that flows through into the fund managers and the retail clients to start buying the stock even further. So you can see that when a company beats, what happens after, it goes on with it. And just to give three up the top end there, you've had A2 Milk, which has been a standout performer over a few reporting seasons now, jumps up, and after the result, it just continued on. Same with Altium, which is another stock, and Nine Entertainment. Conversely, on the other side to that, if they miss, there does seem to be a momentum trade that continues the pressure on the stock, and it's exactly the opposite to what I just mentioned with the beat. So analysts downgrade their numbers, then fund managers continue to sell the stock down. So a couple of the poorer performers there, the WiseTechs and the BWXs and the IPHs, they continued their downward slope. So really, it's looking at that momentum and looking on that first day how they went. Was it a very good result? You keep it or you add more. Was the result really poor? You really have to consider why you're in that stock. So the real backdrop to this is global growth, and I'll touch a little bit more on where we like to position in this stage of global growth. But the bellwether for the global economy is the US. So I'll be taking a little bit of time on their economy and their reporting season as well. So over the past few reporting seasons, the US market has had double digits earnings growth quarter on quarter. It's been a phenomenal run, but we're now going in to their second quarter reporting season, and this does have to do with the tax cuts that have come through, but they're now looking at 18% earnings growth. To put that in perspective, that's the best earnings growth, if they hit it, in over 7 years. And really, another exactly what I touched on before, earnings estimates in our market usually deteriorate in. Theirs have been actually revised up going into the reporting season. So we think that there's a high possibility that they're going to hit this 18% earnings growth forecast. Now, what does that mean with how the US market trades? So again, we've had volatility, and I'll get to that in a moment. But if you look at where the US market trades at the moment and where the earnings growth sits, it's at 16.5 times, and they're looking at 18% earnings growth. So compare that to us. We're at about 15.5 times with only 7% earnings growth. So when everyone talks about how expensive the US market is. We think that it's actually backed up by the earnings that have been coming through, and it's not just this reporting season. We've gone through this over the last few webinars, and it's a consistent theme. So really, what's behind that? The US economy is going well. Their unemployment is at historical lows. They're at 4%. Their GDP has been continuing to trend higher. You can see down in the bottom right-hand corner, we've just given the GDP growth numbers for a few of the major economies, but the US is trending higher. It's pretty obvious to see. While we are starting to see a little bit, not so much of a moderation, but people start to talk about where we are in the cycle. Our chief economist is saying that at the moment, the quarter was about 3.3% GDP. It's going to trend back below and hit that 2.7 for 2018. It's not just the US though. China, Europe, pretty much all major developed economies are trending well. The only, I suppose, caveat to that is we do have the political risks remain elevated. So just three things to consider with where we are in the world at the moment and how things are tracking. So yes, things are really good, but we're now in the third longest bull market in history in the US. If they reach 30 June without another 13% downside, it will be the second longest. So we are moving into a more mature stage in the economic cycle. And really, where do you want to be positioned in this stage? We believe that commodities will continue to outperform. We did see a basing in the back end of 2016, and since then we have been trending higher. But just in this last quarter of 2018, we've seen oil rise substantially. We're now at over $70 a barrel for Brent and about 65 for West Texas. It's these sorts of areas that are showing good growth, and it was evident in our reporting season. So we expect that to continue. But the one thing that you do have to remember in late stage cycles or late stage bull markets is that volatility does start to pick up. So you really do need to be careful or more cognizant of the fact on your asset allocation. So big news headlines this year. I'm going to touch on this one first. The other one's the banks, is the return of volatility. I just wanted to put this into perspective to begin with, is the fact that 2017 actually saw unprecedented low volatility. The markets had never gone up consecutively month on month for 12 months in a row in the United States ever. So to the backdrop of what's happened now, where it seems like it's just that the volatility that we've been experiencing over the last month is the unusual part. It's actually the previous 12 months was more unusual. Still, February hit, there was a spike in bond yields, which was caused by a wage print data over in the US. It just signals that the economy is starting to accelerate quite quickly, and that inflation pressures are starting to build. We saw a really large spike in volatility. But again, if you look down the bottom, this is the 12 worst shocks in volatility since the GFC. This rate's second. So it's not the worst we've ever seen in the world, even though there was some pretty dramatic headlines being thrown about. And keep in mind that this is only since 2008. There has been spikes like this before in history. We think that while it's not going to go away, that volatility will remain. We don't believe we'll go back to the 2017 levels for as long, but it does create opportunities for investors to create positions or to enter positions when there is this large swings in the markets. And we think that going through that, the earnings growth and the economic backdrop will be supportive for equities throughout the remainder of 2018. So the second headline that's currently ongoing is the banks. There's the Royal Commission on. You're seeing quite damaging articles being thrown about, and it is important in our market, because if you look at our market, you've got the banks and the materials, and they really do control where our market goes. So there, a lot of retail investors hold these. They're there for the yield, so it is important. But in reality, if you look at where the banks have performed this year, so compared to our market, there's Westpac's actually beaten it, but the other three have had just a slight underperformance. So it's not all doom and gloom, and we think that's because institutional investors are looking at these and going, well, they're on almost 10% yields. Their PE multiples, about 11 times. This is, and I've just put in a little graph on CBA just to show you that this is really the cheapest that you've been able to get CBA on a price to earnings level for around about 5 years. It did touch there in 2016, but really you have to go back past 2013 to see CBA on the same earnings multiple. So we think that there is this underlying value, and it's creating an opportunity to enter the banks. So Mark touched on it before, but I'll just give a quick update on the fixed interest market. Bond yields, we believe, are moving higher. We've seen the spike that happened in February. It's sort of moderated through the last quarter, but we think that this is that we have seen the lows of bond yields and global interest rates in general, and that over the medium term we're going to be moving higher. So what does that mean for the hybrid market? Well, there's a lot of things going on in that hybrid market. Mark touched on it. We've had a sell-off. There was about a 2.5% sell-off with the franking policy announcement. And on top of that, there's also been new issues that have come to market. So there has been a little bit of depression in this area of the market. We think this is going to abate, and there's two reasons. One, there's not that many new issues, we believe, that are going to come over the next 12 months. So once the repositioning in portfolios has been done, you usually do see a bit more strength coming in. And then second, because these are all floating rate notes in the hybrid market, we've seen quite a large spike in the BBSW. So that's the benchmark in which a lot of these are set off. So if you've got a quarterly distribution, you're on the 3-month BBSW. It was about 1.8% at the start of this year. It's now moved up over 2%. So if you're holding a hybrid and you've got a capital value that's decreased, that's fine, but you've got a set margin above the 90-day bank bill swap rate. If that's moving higher, you're actually getting more yield. So we think that that's going to be supportive in over the next 6 months as people begin to realise this. So what are we doing now? I touched on the bond yields. We've had a bit of a spike from the start of 2018, and we're just cautious on overweight positions on utilities and bond proxies. So, you're looking at your APAs, your Sydney Airports, your Transurbans. They've had great years, so, and they're good businesses. It's just that we would be cautious if you overweight these stocks, you might want to consider trimming them. And again, it comes back to global growth. If that's picking up and inflation's picking up, we like the commodity story. So we like the BHPs, Oz Minerals, Oil Searchers, Rios, Fortescues, those sort of companies we think are going to outperform over the next 12 months. It is quite hard to find reliable cash flows that are outside the banks for yield. We've thrown out a couple. we don't buy resources for yield, but we think that the cash flow is quite sustainable for BHP, and there's a potential catalyst for a capital return over the next 12 months. Another is Macquarie Atlas Roads, which is, I suppose you can throw it in with the utilities and infrastructure stocks. It's been sold off. We like the fact that they're going to now roll their interest rates, their interest exposure from around about 5% to their current levels now, and we think that will just flow through into their dividends. So we expect a dividend pickup in Macquarie Atlas Road over the next 1 to 2 years. The momentum earnings, which really does seem to be prevalent, particularly around reporting time. You've got your A2s and your next DCs in there, and Macquarie Group is another one. And then I suppose it's on the back of that global growth again is following those structural tailwinds. So we like the US with you've got your large cap technology stocks in there with your Nasdaq NDQs or your core S&P 500, which is your IBV, BHP and some of the mining contractors. But with this volatility, please be mindful with your asset allocation. So, look, lastly, I thought I'd touch on Morgan's runs model portfolios. These really are designed, they have specific criteria, but they're really designed to maximise total shareholder return for that specific mandate that they run. But, look, thank you very much. That's all for today. We'd like to thank you for tuning in, and hope to see you next time. Thanks.